Hey everyone, and welcome back to another video for today. So in today's video, we have quite a lot to talk about. We have CoreWeave raising another $2 billion or so. Stock is down at the time of making this video. I do want to touch on two companies, two stocks that, in my opinion, are still flying under the radar. One is actually way more impressive than what I thought previously. And then, of course, I do want to touch on the whole Netflix, Warner Bros. And Paramount situation. So all of that in this video. Alright, so last week, big news came out. Netflix is going to acquire Warner Bros. For around $82 billion. That's the enterprise value, but it's not going to buy the whole company. It's only going to buy the strategically important assets for Netflix, the streaming business, which is HBO and the studio, and of course, the IP that comes with it. Now, today we've had breaking news that Paramount is coming in to this whole discussion, but not coming in through the back door. They are taking the front entrance. And so right now we have this, a hostile tender offer has been launched by Paramount. So the Netflix deal, which is signed already, it's accepted by the board. The price here is $27.75 per share. The structure of the deal is cash plus stock. So $23.25 plus $4.50 of a Netflix stock. And the deal here is, of course, for the studios and streaming only. So the valuation is $72 billion in equity, $82.7 billion enterprise value. Now, of course, if the deal were to fail because of regulatory issue, if it's Netflix's fault that the deal doesn't go through, Netflix will pay Warner Bros. $5.8 billion. Now, on the other side, if it is because of Warner Bros. That this deal does not go through, they will have to pay Netflix $2.8 billion. Basically, if they accept the Paramount offer, because the Paramount offer is going directly to the shareholders. And the offer does expire a month from now, January 8th, 2026. The offer is $30 per share, 100% all cash, and that's for the entire company. So here you can already start to think about, okay, so it is higher, it's $30 per share, but then again, it's for the whole company. Now, how much value per share is the cable side of the business, right? Because Netflix is already paying $27.75 for studios and streaming only. So how much is the cable side worth? Well, I guess less than $3, because Paramount believe that their offer makes a lot more sense. It's also 100% all cash. The CEO actually had something to say about it.
Our offer is $30 a share, all cash, $41 billion in equity that's backstopped by the Ellison family and Redbird, $54 billion in debt with commitments from Citi, Bank of America, and Apollo. We have faster regulatory certainty to close, and our deal is pro-consumer, it's pro-creative talent, it's pro-competition, and we believe that when you actually, to further contextualize, our $30 in cash, $30 a share, is basically $17.6 billion in cash more than the $23 in share that they signed up.
Right. Well, you're not obviously paying. You're paying for global networks. Their deal doesn't involve paying for global networks, which are traded as its public company. Which, by the way, also figures very prominently here in trying to determine what the overall value of the respective deals are, because there are $27.75, including obviously the stock portion of their deal, but it also includes, well, what's global networks? Is it a $2 stock? Is it a $4 stock? What do you see? Because that can go a long way in terms of at least determining why the board may have said, no, we think Netflix is superior.
So respectfully, we think that basically that's valued at $1 a share. I think if you
why
look,
$1?
So if you look at Versant and where the median of all of this is, it's about 4.5 times. You have to get to 5 times equity value or more to basically get to the kind of $3 plus that you're claiming. But again, I think the most important thing to go back here is, look, we're sitting on Wall Street where cash is still king. We are offering shareholders $17.6 billion more cash than the deal that they currently have signed up with Netflix. And we believe when they see what is currently in our offer, that's what they'll vote for.
Now, I don't know about you, but when I look at Netflix, which is an over $400 billion company, when I look at free cash flow for Netflix, that sits closer to $9 billion over the last 12 months. And that's expected to reach $14.5 billion by fiscal 27. If I look at Paramount, they just acquired, well, their last acquisition was Skydance, which literally didn't close that long ago. They already have quite a lot of debt. And as you can see, fiscal 27, they're only expected to generate $735 million in free cash flow. So yes, they might offer a higher deal here. They might offer a higher price to shareholders, $30. But what you're getting here is two, let's say, smaller players. Warner Bros., by the way, are financially okay. Free cash flow is doing quite well. But as, let's say, shareholders, yes, you're getting here $30 per share, which is a little bit higher than what Netflix is offering. But on the one side, you can become a Netflix shareholder in the end, which, in my opinion, is a financially better company than what a combined Paramount Warner Bros. Is going to be. Way less debt, and a lot more free cash flow. Now, I've seen already a couple of people talk about, oh, Netflix is going to be a monopoly. Well, it's not going to be a monopoly because if you purely look at streaming, when looking at the overall TV market here, streaming is 45.7% and of course growing. But inside of that, YouTube is growing much faster than all the others. YouTube is 12.9%. So even when you'll be adding the 8% of Netflix plus the 1.3% of potentially Warner Bros., you are still not getting to where YouTube is. Now, I own 0 shares of Netflix, 0 shares of Warner, and 0 shares of Paramount. So I am just here sitting on the sideline eating popcorn and seeing how this succession story is going to play out. Then we've had the CoreWeave announcement of proposed $2 billion convertible senior notes offering, could go up to $2.3 billion. They are, of course, going to use some parts of that money for capped calls. So dilution is going, well, they hope to keep dilution as low as possible. And the rest is going to be used to, of course, accelerate the business. In their case, build more data centers, buy more GPUs. And this, of course, led to CoreWeave go down around right now 5 to 6%. Moving on to the last part here, and that's talking about two very interesting companies. One, if you're a parent, you probably know it already because you've been spending quite a lot of money on Robux, and that's Roblox. The other one is Grab. Now, before diving into those companies, if you enjoy this type of videos, hit all the buttons. We'd really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also a special thanks to Fiscal.ai, the platform that you're seeing here on the screen, for sponsoring this video. There is a link to get 15% off in the description and in the pinned comment. New users will get Fiscal Pro for free for the first 2 weeks. And of course, all the data that you're going to see is coming from this platform. So Roblox is a $67 billion company that's experiencing a drawdown of around 32%. Now, year to date, the stock is still doing quite well. Year to date, it's up 63.3%. Now, we can look at a couple of metrics for Roblox, and you can see that for free cash flow, these are the numbers for the last 12 months, it has reached an inflection point Q3 2023, and since then, it's been going up and to the right. Stock-based compensation to revenue has peaked also around that period, and since then it has been coming down. Net income is still negative. So if you're purely looking at earnings per share on a GAAP basis, net income here in this case, it is still not profitable. But from a cash from operations or free cash flow perspective, it is very profitable. And so, you might have guessed it, operating margin is still negative, in this case, negative 25%. Free cash flow margin has been improving up and to the right, 26.15%. Gross profit margin, 25.4%. And net profit margin, of course, as we've seen, it is negative 21%. But when you look at cash from operating activities, that sits at $1.3 billion over the last 12 months and growing. Moving on here, in case you didn't know how popular Roblox really is, I compared Roblox to Fortnite and Minecraft. Looking at the interest over time over the past 5 years worldwide, I was as surprised as you to see that Roblox and Minecraft are almost as popular right now, but It does seem, well, this is Minecraft, probably the movie got released, so there is that. But Roblox is extremely popular. Revenue is still expected to grow almost 35% compounded annual growth rate from 2024 all the way to 2027. Free cash flow, we've seen how fast that has been growing. Again, this is a company that most of us have heard about, but we don't really know how big this thing has become. Now, here starts the interesting stuff. So, average revenue bookings per daily active users, of course, peaks during the period that we're in right now. We can see that year over year, it was basically flat last quarter. But look at this. Average total monthly unique players soared last quarter to around 90% growth year over year. Hours engaged also increased 91.3% year over year. And by the way, those are billions, okay? Billions, 39.6 billion. It's insane. This is a company that does numbers and has a user base that keeps on increasing. It's quite crazy. Then, of course, the previous bear case with Roblox is that the majority of their users are under 13 years old. Once they grow up, they won't use the platform anymore. Well, here they basically show us by age group. Hours engaged under 13, 67% growth year over year. Last quarter, over 13, 107% year over year growth. That's not all. We have here daily active users globally did increase close to 72% year over year last quarter. If we then look at the daily active users by age group, you can here also see under 13 increased 44%, over 13 increased 89% year over year. As for bookings, last quarter increased 70.3%. Then if you look at bookings per region, that's going to be important. You can see that last quarter, we've had US and Canada increase 50%, Europe 90%, APAC 110%, rest of the world 129%. Why is that important? Well, because clearly there are markets where monetization is easier and higher than other markets. Rest of the world is, of course, lower than Europe, US, and Canada. Same for APAC, lower than US and Canada and Europe, which is why we've seen the average booking per daily active users overall stay flat year over year. That's just because the regions where monetization is not as high as other places, those have increased more than the US, Canada, and Europe. And so if we go and look at the stock right now, it is trying to make its way back above the 200-day moving average, which sits at around $98, $99 or so. It was previously oversold, just like many other stocks mid-November. I do think that this one, if they continue to execute, which I believe they are, because the games on there, okay, maybe it's not for me, but they're definitely doing something right. And I know there is a lot of controversy around predators on the platform as well. They need to fix that ASAP. But the games, how stupid they are very popular, right? The brain rot stuff or the other things, they are very, very popular. There are a lot of big brands that partner up with developers on the platform. Lego, I believe we saw Nike one, Chipotle, etc., etc. There are a lot of collaborations, a lot of big brands that want to have exposure, yes, inside the game, metaverse style. Yes, this is a real thing. Moving on to stock number 2, and that's a stock that we did discuss during the live stream today because a lot of the Amit refugees came to the live stream. I really appreciate that. And that's Grab. Now, remember, we talked about Grab a year or so ago, and I said, is this a $100 billion company in the making? Just a small reminder, this is already today, despite the just $5 price per share, this is already a $21 billion company. That's the thing. A lot of people just forget about it. They see the stock price and they assume that this is a very, very small company. And it happens both ways. Some people see, oh, this stock is trading at $500 per share. It must be a $200 billion company. But no, that's not how it works. So with Grab, do I still believe it has the potential to be a $100 billion company in the future? Yes, I do. Because they're executing, they're doing what they should be doing. They're operating also in countries where GDP is growing fast and is still expected to grow fast in the foreseeable future. And Grab, being a leader in a lot of these markets in Southeast Asia, well, they're of course going to be benefiting from that every single year. Now, if we look at a couple of metrics for a Grab, over the last 12 months, free cash flow has remained positive, well, for the last year and a half or so. Yes, it is now down because last quarter, free cash flow, where there was no free cash flow, it was an outflow. So that's why we're seeing that impact over the last 12 months where free cash flow is down quite considerably. Looking at stock-based compensation to revenue, that of course is very, very low and coming down. And then net income has flipped. Net income here over the last 12 months, including Q3, Q2, Q1, and Q4, it has flipped. We are now net income positive, which then leads me to operating margin. That of course has also flipped. Free cash flow margin sits at 5.61%. It was higher before. Fintech arm, they're growing that quite quickly. You're going to take here a hit on the free cash flow margin side. Gross profit margin has been flat to improving, 43.1%. And then net profit margin here, of course, slightly positive, 1.8%. Now, for those that are unfamiliar with Grab, they're basically trying to be that super app. Yes, in Asia, Southeast Asia, super apps do exist, whether it's WeChat in China or in this case, Grab. So they report group financials, revenue, on-demand GMV, and then adjusted EBITDA, and then of course they split it up. They have deliveries, just like with Uber, they have mobility, and then financial services. Now, me personally, my conclusion, of course, from a year ago was, okay, this is a great business. I like the markets that they're operating in. I like the growth rates. But then I also found out that Uber owned 13% or so of that company. And what happened with Uber late last year, stock took a hit, went closer to $60 or so. And I was like, okay, I can buy Uber. It is an overreaction. Plus, I do get exposure to Grab. So let me choose that. I'm still very bullish on Grab and the thesis remains the same for me. I've actually made a couple of videos about Grab since a year ago. The thesis hasn't changed, it just has improved. The stock hasn't moved, which is quite good for long-term shareholders because you're seeing your thesis play out while the stock doesn't move, which gives you more time to accumulate more shares. Which then leads me to this nice graphic from our best friend Nano Banana. So this is basically what has happened last quarter. Monthly transacting users up 6 million year over year, on-demand GMV up 24% year over year, group adjusted EBITDA up 51% year over year, adjusted free cash flow trailing 12 months up $185 million year over year, again adjusted free cash flow trailing 12 months. As for segment growth and efficiency, delivery GMV growth 26%, mobility GMV growth 20%, and financial services revenue growth of 40%. Regional corporate cost operating leverage have improved by 150 basis points. Then the key takeaways, strategic drivers of last quarter, product-led growth driving MTU. MTU is monthly transacting users. Daily users growing faster than monthly. This is because of increased frequency. Sustainable growth via Grab Unlimited. That's over 20% of delivery MTUs. And Grab Mart 1.5 times faster than food. Financial services accelerating, $3.5 billion annualized loan run rate. Of course, every time we look at these companies when they're trying to grow their financial services arm, there's always going to be the, let's say, bear thesis on, okay, bad loans, good loans, non-performing loans, how good is your underwriting, etc., etc. Then as for the future bets, they've announced a couple of AV partnerships and advertising as well. This will cause margin expansion. And so for guidance and long-term targets, they have raised fiscal year 2025 adjusted EBITDA to $490 to $500 million, financial services loan portfolio of over $1 billion by year end 2025, financial services break even in the second half of 2025. Long-term margin targets are deliveries 4% plus, mobility 9% plus, and they maintain profitable growth into 2026. Which leads me back to this chart right here. Stock is still, yes, in the $5 range, in this case sitting right above the 200-day moving average, which sits at around $5.10 or so. Now overall, the market right now on Monday, as you can see, is not the greatest picture. On Wednesday, Fed meeting, interest rates cut, commentary. We also have Adobe, Oracle earnings report, Broadcom, on a Thursday, and apparently we're not going to get a PPI data. So that's not great. But anyways, that's it for me in this video. Do share your thoughts down in the comment section below. Check out fiscal.ai to get 15% off. Link is down in the description and in the pinned comment. And we'll see each other in the next one. Bye-bye.